Mr. Stingler presented a performance review and they adjourned.
Excellent. And there's no discussion. We'd like to have a vote to accept the minutes.
Move it.
All
Second.
in favor?
Aye.
Aye.
Opposed? No. Is there any public comment? If not, Britt, would you like to introduce Capital Group?
Sure, happy to, Frank. Happy New Year, everyone. So today presenting, we have Ronan and Chris, it looks like, from Capital Group, who are going to review the target date funds and the DC plans. Just as a reminder, they've been the the target date fund provider for the DC plans since the record keeper conversion. So coming up on about 2 years so far, but they'll give a detailed review of the glide path, the investment process and performance, and please ask questions along the way. And with
Perfect.
that, I'll turn it over to Ronan.
Right. Well, good evening, everybody. Hope everybody is doing well and you're surviving the cold and the snow. Thank you for inviting us to present this evening, and thank you for the trust you have placed in us to manage target date for your participants. Before kicking things off, let me quickly confirm we're still good for kind of 20-25 minutes of prepared remarks. Does that sound okay to everybody?
Yep. That's perfect.
Fantastic. Thank you. And again, as Britt said, please feel free to ask questions as we go. So let me start by introducing you to the presentation team today. My name is Ronan Burke, and I lead our public funds team in the eastern half of the US. I have 35 years experience, the last 27 of which I have worked with public funds like yourselves. And I've been with Capital for almost 8 years, and I am just up the road on 95 in Madison, so sharing in the pain of shoveling snow. Anyway, joining us also today is your relationship manager, Christine Wan. Christine has 10 years of industry experience and has been with Capital Group for 7 years, and Christine is based in Los Angeles. And last but no means least is Rich Lang. Rich is a multi-asset investment director at Capital Group, and inside Capital, we lovingly call him Mr. Target Date. He has 27 years of investment industry experience, all with Capital Group, and he too is based in Los Angeles. So that's your motley crew for today. With that, let me turn it over to Christine.
Great, thank you so much, Ronan, and thank you for allowing us to present on the American Funds Target Date series. So I just wanted to start off with a quick overview of the firm before I hand it off to Rich for the deep dive on the retirement series. Let me go ahead and turn your attention to slide 5 here. So Capital Group was founded in 1931 with the mission to improve people's lives through successful investing. We're home to the American Funds family of mutual funds and offer a variety of investment vehicles and equity, fixed income, and multi-asset strategies, all of which are actively managed. We are one of the largest privately held investment management organizations in the world with 2.6 trillion in assets under management as of September 30. Excuse me. Being privately held has allowed us to take a long-term approach in how we manage participant assets, which is extremely important as we think about target date participants who have a very long investment horizon. So this long-term focus is not only evident in the long tenure of our investment professionals, but it also drives our approach to how those professionals are compensated. Compensation is based on performance on a 1, 3, 5, and 8-year basis, with increasing weight on the longer term periods. We have an objective-based investment approach to focus on delivering superior long-term results through our proprietary investment process known as the Capital System. Under the Capital System, our multiple portfolio manager teams deliver high conviction portfolios backed by rigorous research and analysis. This process really allows for smooth generational changes and also alleviates any concerns of a star or single manager system. The Capital System provides continuity of process and a philosophy that really reinforces our long-term approach. And this approach has helped many of our underlying funds in the series generate attractive relative, absolute and risk-adjusted returns compared to our peers. So, this combined with our low fees have made many of them popular in the DC market. So lastly, with that, we are proud to be a leader in the defined contribution business, with American funds among the 10 most used mutual funds in the DC plans by asset category. So every one of the funds listed here on the slide are used within our target date series. So just to give you a sense of our global footprint, Capital Group is one of the most experienced global managers with a rich history of investing. We've been investing outside the United States since the 1950s and helped create the first global market indices, the MSCI. We are actually the CI in MSCI. As a global organization, we have over 400 investment professionals worldwide, with more than a third of these professionals located outside of the U.S. In research and service offices across the globe. Our investment professionals come from, very diverse backgrounds, with many speaking local languages, and their proximity to each company headquarters is extremely helpful in building relationships with senior leaders of those companies via in-person meetings. And really, these relationships have made the recent transition from in-person meetings to virtual meetings much more seamless. In fact, since the work from home initiative has been put in place, our investment professionals have conducted 5% more meetings with companies than they had over the same period in 2019. So with that, I know that was pretty high level and I moved very quickly. I'll pause here to see if there are any questions before I hand it over to Rich for the review. Okay, hearing none, I will hand it over to Rich.
Okay, thanks. Can you maybe scroll to slide 9? There we go. And I promise my name is Rich. I just noticed my name says Christine. I don't know why that happened, but and I actually worked with the Target Date Solutions Committee back when we designed the series in 2006. And here you can see the inception of the series goes back to 2007. So we're approaching a 15-year track record. Our assets now are approaching about 230 billion as of year end. We manage target date assets. I think more importantly, the amount of assets is important. In fact, we're the fastest growing target date series in the industry, but we manage assets close to 8 million participants in our target date series. And I'm 100% invested myself in the 2035 vintages. A lot of folks within Capital invest alongside your participants. The glide path is managed 30 years through retirement. We feel at age 65, participants are still long-term investors. They need meaningful equity, but the amounts and the types of equities we feel should continue to change as they age. Really, our objective in our series is the two primary needs that participants has as they save for retirement. They need to accumulate as much wealth as they save for retirement, and then preserve that as they approach retirement and begin to take distributions. So we try to balance that. How do we build wealth for participants? We provide meaningful equity, above average equity for participants compared to the Morningstar peer across the glide path. We rely on global diversification, and then we rely on our ability as an active manager over longer periods, being able to consistently provide excess return net of fees compared to index investing. How do we preserve wealth? We take a strategic approach in our glide path. Every provider in the target date industry reduces equity as participants age. What we do that's different is we also reduce the volatility of our equity. We also rely on our fixed income to offset equity volatility. And then once again, active management. Our equity funds, if you look at their historic lifetime results, their average downside capture ratio is about 85%. And what that means is when indexes sell off, we're going down. If indexes are down 10%, our funds are down 8.5%. May not sound like a lot, but as we know, the arithmetic of a loss, the more you save on the downside, the less you have to make up on the upside. So that over longer periods has really helped our underlying funds and our series hold up quite well in a multitude of market environments. The next slide, we look at the team that oversees the Target Date series. This is the Target Date Solutions Committee. And here you can see the investment professionals average 30 years of experience, some of our most tenured investment professionals. And it's a combination of folks that are also managers of some of the underlying funds. So Brad Vogt, you see there at the top, he manages some of our domestic equity funds. David Hogue is an investment grade fixed income manager. Jody Johnson manages on some of our global equity funds, and Shannon Ward manages on our high yield fixed income fund. So they have the intimate familiarity of what's happening in those underlying building blocks that go into our target date series. And then we have 3 dedicated solutions managers. You have Michelle Black, Samir Matur, and Wesley Foy, who are 100% dedicated to the management of the target date series. And we think that combination is important. And then in addition to this group, we have a group of 20 analysts, the capital solutions group, that are responsible for the persona assumptions, the capital market assumptions that go into the modeling that support our target date series. They track the underlying funds in real time basis, what's happening to the allocations in those underlying funds and the results of those underlying funds and how that might be impacting the results of the series. So a meaningful dedicated group that oversees and monitors the target date series. If we go to the next slide, you can see this objective-based glide path. Christine mentioned earlier that our funds are managed to objectives and have been managed to objectives for over 80 years. And we participants saving for retirement, they don't have asset class needs. They need appreciation, they need income, they need preservation. And we think this construct really aligns well with those needs. So here you can see what we're targeting in our glide path are our growth funds, our growth and income funds, and our balance funds. So those blue shaded funds and the equity income funds are more equity focused funds. The growth funds are looking for appreciation. Growth and income funds are 100% equity funds that are looking for appreciation, but then also have an income component. And what you'll notice is as you get closer to retirement, participants' equity portfolio has a greater percentage coming from dividend paying equities. And in the distribution phase, you can see really their entire equity portfolio has some sort of dividend component. And historically, the more dividend focused areas of the market have been more resilient when equities have sold off. And we feel these are the types of equities you want for older participants versus younger participants. And you can see this on the next slide when we look at the top 10 equities held for the different vintages. If you click on the next slide, there we go. So you can see the 2055 funds. So, what does a 30-year-old hold as their top 10 equities in our target date series? And you can see the darker shaded blue are those that have a yield below 1.5%. And you see many of the growth type stocks you want for younger investors. You see the Facebooks, the Netflix, the Amazon. But someone in the 2015 fund, 70 or 5 years past retirement, a 70-year-old, what types of equities are they holding? You see a much higher yield. You can see the weighted average yield of the top 10 equities of 2.14% for a 70-year-old investor versus 88 basis points for a 30-year-old investor. So not only are their equities being reduced as they get closer to retirement and enter retirement, the types of equities are much different.
For the pension board. Bye. I can't, Henry, bye.
So I would say this is probably our biggest differentiator in how we're able to provide above average equity with lower volatility is this approach we use within our equity. And then also fixed income on the next slide here. We really want our bond funds, as we like to say, to behave like bond funds. So what we're showing on this slide are the fixed income funds we use in the target date series and looking at their correlation to the equity markets, the S&P 500. So the blue bars represent the correlations of our funds. The gray bars represent the Morningstar peer average. And I'll highlight 2 funds that we use quite meaningfully in the distribution phase, Intermediate Bond Fund and Short-Term Bond Fund of America. Shorter maturity funds that really have preservation of capital as part of their objective. And you see their negative correlation to the S&P 500. Well, if you look at the peer group, much higher correlation to equities. So what that tells you is peers in the group are stretching down the credit quality spectrum, investing in lower grade investments to get higher income, but they're sacrificing that for greater volatility. And we really want our fixed income funds to offset equity volatility in our series. The next slide, we look at the underlying funds we use at various points in the glide path. I would say another differentiator of our series, in addition to changing the types of equities, is we use funds in the series that have a global objective. So we use funds like New Perspective Fund in the growth category that will invest in global stocks, Capital World Growth and Income within the growth and income category. We'll also use funds in the equity, income, and balance categories that will hold both stocks and bonds. We feel our strength as an active manager is security selection, finding the right companies to invest in or the right bonds to invest in. We feel it's difficult to make top-down tactical allocation decisions. So we want to incorporate some level of flexibility to come through those underlying funds. So on the next slide, you see the asset class exposure you get via this approach. We really view asset classes as a means to the objective ends. So I would say other target date fund providers will target a specific asset class. It might take a more rigid approach to an asset class. We want to let the managers within a range choose the asset class that is going to help deliver the objective that participants have. So here you can see the exposure to, a broad set of asset classes. You see emerging market equity exposure, emerging market debt. You'll see the REIT allocation. We don't have a dedicated REIT fund that we use in our series, but you'll get REIT exposure through the flexibility of some of our underlying funds. And then if you go maybe to slide 17, slide 16 shows you this asset class exposure in kind of a tabular form. But here, slide 17, you can see this range I talked about. So you can see over the lifetime of the series, the gray shaded area shows what the range has been for the series as far as equity exposure. That's the upper left-hand corner. So you can see the current allocation is towards the higher side of our historic equity allocation. And in fact, in November, we just made a rebalance to reduce that equity a bit to get below a threshold range that we have, that we monitor the series closely by. So these ranges are monitored quite closely. You can look in the upper right-hand corner and see what the non-US exposure has historically been over the lifetime of the series. You'll notice, once again, it's towards the lower end of that historic range. And in fact, over the last 10 years, we've had lower non-US exposure than that average, also lower than the peer average. And that's been additive as non-US markets have trailed US markets pretty meaningfully over that time frame. So incorporating that degree of flexibility has helped the series generate strong results. And then you can also see the style flexibility and the market cap flexibility. On the next slide, you can see the historic changes we've made to the series over the lifetime. The most recent change we made was in April of this year. And, part of the change was embracing some of that global flexibility I mentioned. So we did increase exposure to some of our global funds, reduced exposure to some of our more regional pure funds, our more international funds like a Euro-Pacific Growth Fund, and some of our more domestic equity funds. We did increase our small cap flexibility. We went from a 7% dedicated allocation to 10%. And then we diversified our equity a bit in that distribution phase. But you can see not a lot of changes over the lifetime of the series. That goes back to 2007. But it is something, we continue to monitor. And if it makes sense, we will make strategic long-term changes to the series.
Question?
Yes, please.
What about longevity? Have you made any adjustments for that? I mean, people are living longer and.
Yep, we haven't. So actually, it was interesting. We were one of the few providers that manages our series 30 years past retirement, so to age 95. So I think we've always taken a pretty long-term approach in realizing that, a married couple age 65, there's a good chance, 50% chance beyond that one of them lives to age 95. It's interesting, within the industry, you're seeing more providers increase as how far they manage their series into retirement. TIA is a provider that used to manage 10 years through retirement. Now they've changed it to 30 years through retirement. JP Morgan is a provider that used to manage to retirement, And now they're making some changes to their series where they're understanding, folks will be using this target date series living longer. They need to think of it more as a distribution vehicle. So I think you're seeing within the industry, some providers adjust to that longevity. But when we designed our series, we were really the only one in the industry. Us and T. Rowe Price were the only providers in the industry that manage it 30 years through retirement. So I think our series is pretty well designed to address those longevity concerns.
Thank you.
Another question, are most of these funds managing exclusively retirement assets, or is it a mix of current and deferred assets?
Yeah, I would say if you looked at the assets in our target date series, I would say roughly about 90% are in qualified retirement plans, DC, 401k. You do have some folks that might use them in a rollover as well, but yeah, overwhelming majority are more used in retirement plans.
Does that, the fact that you don't have to worry about, the investors don't have to worry about taxes, does that change your trading strategy at all?
It's definitely something we think about. So, I mean, we did have some capital gain distributions because if the underlying funds that are part of the series have capital gains, the series has to distribute it. I would say our underlying funds, taxes are managed within our underlying funds. It's not the final decision on whether they buy or sell a security. But yeah, it's going to have much less of an impact in our target date funds because of that 90% of the folks are in those qualified plans.
Okay, thanks.
Rich, do you mind touching on any changes to the glide path that you've made or expected, or kind of the review process and the team conducts and thinking about changes and potentially making changes?
Yeah, so I would say, currently what we're working on is some fixed income. I will mention tips. Actually, we have a white paper that I just finished. I think it's in legal right now as far as inflation protection. A lot of discussion around inflation. I think the year-over-year inflation through 12/31 was just updated. I think it's about 7%. So how we manage tips. So maybe, Christine, if you can go to slide 16, and these numbers are as of September 30th. You can see the tips exposure. So we incorporate some of that flexibility. We do have a dedicated allocation to our inflation-linked bond fund at retirement of 7%. But if you look in that fixed income category, kind of right in the middle there, you can see the inflation-linked exposure at retirement is closer to 9.5%, 10%. And actually, I think that the 12/31 numbers now, I think we're looking at 12% in those. So underlying fixed income funds do have the flexibility to hold tips, and you have seen that. So that's something we're thinking about. Over longer periods, we think equities are an appropriate hedge against inflation. And if you look at over rolling 25-year periods, equities have always outpaced inflation. So we think younger participants are well protected by their equity exposure. But as we get closer to retirement, sorry to jump around, you can maybe go to slide 14, Christine. But you can see the actual allocations to our fixed income funds there. And you can see when we phase in our inflation-linked bond fund in that 15 years approaching retirement and how we keep that allocation there. But then you will get additional inflation protection from other fixed income funds. We are looking at other fixed income funds that we manage within Capital Group American funds that are not in our target date series right now, and thinking how they could add value. We have a strategic bond fund and emerging market debt fund. So that's type of research that is we're currently looking at flexibility of our emerging market equity exposure. Similar to how we embrace that flexibility on the global side, is there an advantage to adding a bit more emerging market flexibilities? Right now, we kind of have a market allocation to emerging markets in our target date series. So that's part of the ongoing research. The monitoring happens on a daily basis or regular basis, where we look kind of at the asset class exposure and the results of the series.
Thanks.
Yeah, maybe let's go to the results. So we'll send you this book when it's updated. This is a September 30th. We should get the year-end review book probably in the next week or so. But maybe go to the results slide because the market review will be 9:30 numbers. So yeah, go to slide 24, Christine, if you don't mind. Yeah, so this is a slide that illustrates that preserved capabilities of our target date series. So even though we have more equity, what we're showing here is how the series has fared when equities are sold off. So you can see the far left is the financial crisis bear market period. We've had 6 corrections where the S&P has dropped at least 10%. And then on the far right is the COVID bear market period. Granted, it was quite a brief downturn. But you can see generally top third, top quartile of their peer group. So the lower the ranks, the better. This is against their Morningstar peer group. The more green, the better. So our series has held up well, even though we have more equity when equities sell off because of that strategic approach. The downside capture ratio of our underlying funds, moving to lower vol equities, and then how we use our fixed income in the series. But it's not just about the preservation. We talk about balancing the two. On the next slide, we look at our build and preserve capabilities of the series over the last 10 years. So what we're showing here is the upside capture ratio of every vintage that has a 10-year track record against its Morningstar peer average. So you want to be above 100 on the upside. When markets are up, you want to capture more on the upside. And when markets are down, you want to have a lower downside capture. And you'll notice every vintage of ours has more on the upside, less on the downside. And in fact, we're the only provider in the industry with this profile, where every vintage above 100 on the upside, below 100 on the downside. So I think it's a good proof point that, it's easy to do one or the other. You can build wealth, load up on equity, and you can preserve wealth by loading up on fixed income. It's not that easy to do both. And I think our approach has delivered that kind of upon that. The last slide, as far as results, once again, these are September 30th numbers. Let me just read kind of what the returns were as of 12/31. So for the 2065 vintage, the 1-year return was 17.3%. So we had a strong, you can see year to date through September for the 2065 was 10.75, strong quarter. The 2010 fund for the 1 year was up 9.3%. So that's someone age 75. That's a pretty strong absolute return. We did see improvements in those ranks. So you can see the 1-year ranks as of September, you see some 70s and 80s. Actually, if you look at year end, those further dated vintages weren't quite as strong. Our near dated vintages, so everything from 2040 to 2010 ranked in the top, 16% of their peer group. So we saw exceptionally strong returns from those vintages on a relative basis. Near our further dated vintages were kind of in that second quartile, 25 to 50th percentile. But you can see the longer term ranks pretty strong over the 5 and 10-year numbers. As of year end, I'll give you the 10-year numbers. Even those further dated, the 2010, 2015, and 2020 were, 4th percentile, 3rd, and 4th percentile as of year end. So you saw some pretty meaningful improvement from that 9th and 18th and 21st percentile. You see the volatility ranks. The lower the ranks, the better. So a fairly moderate, I think you could argue conservative risk profile based on the volatility ranks, even though we have more equity. And when you combine the strong returns with that low volatility profile, you get those risk-adjusted Sharpe ratio ranks. We should always have strong risk-adjusted numbers. Ronan and Kristen may promise you we'll always be 1st percentile. I'm not here to say that, but we should always have strong risk-adjusted numbers over a 10-year period. And then last but not least, our fees. Fees are incredibly important. We remain the lowest cost actively managed target date mutual fund series in the industry. And the good news is our fees got 2 basis points lower as of the most recent prospectus update as of January 1st. So our fees now, the range is 8 to 38 basis points across the glide path, where it was prior, it was 30 to 40 basis points. So we continue to pass on the scale that comes from our underlying funds and the scale we're seeing in the series in cost savings for participants.
If you go back to the, you don't have to go back to the chart, but the upside downside capture chart that you showed, are you beating your peers by security selection based on market conditions?
Yeah, so actually we don't have it here. We've looked at over our lifetime, we added value in our target date series across all vintages. And there's three ways you can add value as a target date manager. It's by security selection, as you mentioned. If you're an active manager, really that's the only way you can add value, security selection, because if you're a passive target date provider, the other two ways are how you can, it's your strategic allocation to equities. Do you have more equity than the average target date series? Or is it by your asset allocation capabilities? Are you moving into the right asset class at the right time? And we don't have it in this slide, but we do have it in another deck where we highlight where we've added value across our series. And if you break it down, just on average against the S&P target date index, we've added over our lifetime 120 basis points of excess return annualized over that roughly 14-year plus period. And of that 120 basis points, about a quarter of it came from our strategic allocation. We do have more equity than the average, and with stocks outpacing bonds, we've benefited from that. We've benefited from our ability to make bottom-up tactical changes. So I mentioned earlier how we've had less non-US exposure over the last 10 years. That has been additive. So that's part of that flexibility or tactical additive. And then about half of our excess return has come from our ability as an active manager. So our underlying funds, our managers in the underlying funds choosing the appropriate stocks, the appropriate companies to invest in.
So with that perspective, how are you positioned now? Where do you think equities are headed, and what changes have you made in those various levers you can pull?
Yeah, I mean, we're still investing for the long term. If you look at the allocation target date series, our equity funds are still pretty fully invested. Our balance funds that can hold both stocks and bonds are tilted a bit more towards equities. So I think if you look at, fixed income, still a low rate environment. Obviously, the fear is that you're going to have rising rate environment that could be more of a headwind for fixed income holdings. But, even in rising rate environments, we've looked at, fixed income funds can still generate positive returns in a rising rate environment. But I would say we're still positioned for, appreciation through our equities. You have seen a change from market leadership, and you've seen that in our exposure to growth stocks. I would say a year or two ago, we had quite a bit of growth allocation. You have seen that come down in our further dated vintages, and you've seen that over the last couple months where value has outpaced growth. Will that continue? I think that's just people thinking about, all right, what do rates look like going forward? Will that be more of a headwind? We still have meaningful exposure to growth stocks. We have, I would say, changed some of our exposure to China and some of the concerns there. So I would say today we have much more broad diversification within China than what we had before. I would say 3-4 years ago, we did have more exposure to those internet type companies that have come under more scrutiny by their government there. Today, we're looking at more healthcare type companies we feel that can do better in a type of more regulatory state overseeing kind of operation. So yeah, I would say generally we're still pretty optimistic on kind of what we're seeing in the market. We do have an outlook that we publish every year, and maybe Christine, we can follow up with kind of the 2022 outlook and how we're positioning in the market.
Okay, thanks.
Any other questions? Or is there any? If not, I want to thank you. Do you have any other slides that you want to present?
No, I think that's it. Yeah, we'll send you the updated 12/31 deck when it becomes available so you can keep for posterity.
Thank you.
Yeah, and I'll also send along some of the other documents that Rich mentioned during our conversation today. But once again, thank you so much for your time and for choosing American Funds. We appreciate your business, and please don't hesitate to contact us with any questions. We are here as an additional resource for you. So please feel free to lean on us for any additional support that you may need. So thank you so much for your time, and I hope you have a good evening.
Thank you. Thank you.
Thank you.
Thank you.
There's all the smiling faces.
Anybody have any questions or any discussion on the presentation?
No.
If not, Britt, did we sign a 5-year contract?
With who?
With Capital Group?
It's a mutual fund, so you can terminate them like you do any other manager in the pension fund or anywhere else. So there's no contracts. But I think as you heard from Rich, I mean, they're a pretty thoughtful group and they have significant resources and they've done very well. And, you know, I think one of the unique factors is the low priced active management that you get from the series, as well as, you know, a glide path that goes until participants are 95, which there are a lot of target date fund providers out there that go static at 65 and really don't care about participants in retirement. But I think, as Rich mentioned today, it's a key feature that I think benefits participants.
Is there no,
Oh, so sorry, do they make an active effort to, you know, when people go out of DC funds, what, you know, when they actually retire, do they keep their money there? What typically happens?
That's really a plan sponsor decision.
Right.
So, you know, most of my clients, they tend to try to keep participants, even if they're not working for the company or the, you know, the city of Norwalk, where they can use their assets to gain scale, cheaper fees for all participants. And it's typically not a huge burden to keep participants in the plan. But obviously, you know, everyone has the opportunity to roll over their assets into an IRA with their broker. And, you know, they can access a lot of this through that, but probably not as cheaply as the city can through the DC plans.
Mm-hmm.
But it wouldn't be like American funds targeting retired Norwalk participants to,
Yeah, yeah.
you know, invest in other American funds.
Britt, you going to do a performance review?
Yes, happy to, Frank.
Thank
Would you like me to share the screen or does everyone have the report up?
You can put it on the screen like they did. That'd be fine.
Yeah, either way, doesn't matter.
All right, can everyone see that?
Make it bigger.
How's that? A little better?
That's good. That's good. Yep.
Okay, great. So this is September 30th performance report, 401A and 457 plans. You can see the asset distribution here for the 401A, about 10.3 million, up from about 9.9 as of June 30th. Importantly, I think you can see the target date funds have about 91% of assets within the 401A, as that was the default when the plans moved over. Just to highlight kind of the changes during the quarter and where participants are putting assets. You can see the asset allocation on the left and contributions, again, mainly going to American funds, 85%, followed by some of the index funds and the stable value fund. So not a lot of change there from quarter to quarter. And here we show the 457 plans. You can see about 46.3 million, pretty level from quarter before. You can see some older participants taking assets out of the plan and some negative investment returns during the third quarter. Here's a little different than the 401A, given the maturity of this plan. If you recall, the 457 has been around for a very long time. And participants have moved and allocated their funds as they wish, a little more actively than we see in the 401A. So you can see about 70% in the target date funds and about 12% in the active equity options and 10% in the passive funds. And you can see it's pretty broadly distributed for contributions from participants during the quarter. So majority target date funds, I think the industry average is probably around 30-35%. And above that is, in my mind, is not a bad thing. I think target date funds can be good for any participant. Well, lament performance, Rich touched on it quite a bit, but you can see, strong absolute performance for the year and longer periods, and really strong peer performance, really across the board. In terms of the individual options, we have the passive funds up top. I think all of the funds track their indexes relatively closely and performed as expected. And within the active equity options, you can see the income fund from JP Morgan has struggled a little bit over the last year. I think it might be good to have them in at some point in 2022. Mainly healthcare and energy stocks have detracted over the last year. Them, like MFS below them, have a quality bias and a valuation bias, which, in the last few years since COVID's really hit, we've seen the low quality rally and not much discipline when it comes to strong balance sheets and strong cash flows within the underlying firms. So both of them struggled a little bit in this environment, but no concerns, and their longer term performance continues to be fine. You can see GW&K, your mid cap manager, had a great quarter and over longer periods has performed extremely well versus the benchmark and peers. And MFS, International Diversification, protected a little bit and longer term performance continues to be good. And finally, TCW Met West, who's also the Core Plus manager in the pension plan. They presented, I don't know if it was the last meeting or the meeting before, but you can see their performance has been very good. And Invesco, the stable value manager, has been a strong performer as well. Happy to answer any questions on the DC performance.
Any questions?
No, good.
Excellent, thank you.
Great, thank you.
Nod, is there a motion for adjournment unless there's any other discussion?
Motion to adjourn.
Is there a second?
Second.
Any discussion? All in favor?
Aye.
Opposed? No. Thank you very much. And since it is after, if you notice, it was 6:30 that this meeting actually officially starts, if you look. I would like to call the meeting of the pension board, the regular pension board, to order, and approval of the minutes from the last meeting.
I didn't notice any changes. Motion to approve.
I will second that. Second.
All in favor?
Aye.
Aye. Opposed? No. Is there any public comment? There's no public comment. We're going to move on to approval of the pension applications. Jerry, you out there?
Yes, I am. Can everyone hear me?
Yes, we can.
Okay, we have only one application to submit this evening on behalf of Sharon Ippolito, Special Ed Aide with the Board of Education. She's 71, so her pension is regular one. She elected the standard option. Her monthly benefit will be $936.73, annualized to $11,240.76.
Are there any questions? Is there a motion to accept the,
I'll move, we approve it.
approve the, is there a second?
I'll second.
All in favor?
Aye.
Opposed? No. Jerry, now that we have you on here, Mr. Flores did not submit for December. Do you know what the status of that pension is?
It's still the ball's still in his court, Frank. I did send a revised blank declaration of retirement form with a cover letter. I'm not able to reach him by phone, unfortunately, but I did tell him exactly what we needed from him and have not yet gotten revised paperwork from him. If I don't hear from him again, I will see if there is a plan B in terms of reaching out to him. But unfortunately, I can't access him via phone because I don't have a current phone number for him.
Okay, thank you.
You're welcome.
Rick,
What happens if we don't ever get a hold of the guy?
Well, at some point, then he would have to resubmit his pension application, and I believe we are restricted. I'm not sure if there are pension board rules. I believe there are. We may have encountered something similar a few years ago where there was an excessive delay in someone's application being processed correctly or with the requested information, and consequently we could not approve the benefit on a retroactive basis.
Mhm.
I'm not necessarily comfortable with that because the employee's retirement date is how he expressed it, and therefore he should be entitled to a benefit effective with his date of retirement. But that could translate to one lump sum payment being a fairly large amount. That's not to say we haven't done that in the past, but I will look to the board for a recommendation should that be the case. I'm hoping that it won't because it's only been 1 month now. So I think we're still in a reasonable situation with this person.
Okay. Thanks.
thank you, Jerry. Performance review. Rick,
Great. Thanks, Frank. Everyone see the performance report up here?
Yep.
Looks good, yeah.
Great. So this is as of November 30th. You can see about 539.3 million, about 2.7 million going out for benefits and unrealized losses of about 11.5 million. If you recall, in November is really the onset of the Omicron, which has now taken over our lives, and the hawkish Fed and a few other issues going on that really caused a risk-off market environment during the month. The good news is that in December, it was a very strong market, so all of these losses have been recouped. In terms of asset allocation, you can see total equity very close to the target, slight underweight to international equity as well as fixed income, and slight overweights to private equity, absolute return, and real assets. In terms of performance, I would highlight LSV has done exceptionally well. If you recall, they really struggled in this growth environment, and over the last 3 or 4 quarters, they've really turned things around. You can see for the trailing year through November, up about 4.7% over their benchmark. Columbus Circle continues to really hit it out of the park, outperforming by about 6% for the fiscal year to date. And you can see their impressive long-term performance. Artisan struggled, they continue to struggle. We had them in a few months ago. Their growth at a reasonable price and some of their bets within airlines and aerospace have really hurt them of recent. We certainly would like to have them again in the spring if performance continues. Silchester has done well. You can see protecting a little bit for the fiscal year, but long-term continues to be very good. BlackRock has underperformed. You can see for the fiscal year and the trailing year. We'd like to have them in next month to present, if that's okay with the board. They've been in the portfolio for about 2 years, I believe, and I don't think they've been in to present since we interviewed them in the finals presentations. So if it's okay with everyone, we'll have them present next month.
Yep.
You can see your global equity. I'm sorry, what was that?
Said, sounds good.
Great. You can see your global equity long short managers, both ABS and Blackstone, got a little whipsawed in the environment so far in the fiscal year. We have no concerns. I think, we had Blackstone in as well as ABS last year. They are really going to be a good diversification managers should markets continue to be volatile and stop going straight up like they have been for the last 3 or 4 years. Private equity, you can see the 1-year performance number, 45%. This is lagged, so this is pretty stale information, but your managers continue to do well there. And then finally, you can see your fixed income managers, pretty muted returns for the fiscal year and negative returns for the year, but both managers are doing well and beating their benchmark. UBS has done extremely well. If you recall, prior to 2020, 2021, they had some reinsurance issues that detracted from performance, but they've really rebounded, and you can see longer term have done very well. And PIMCO, who we had in last month, struggling a little bit fiscal year to date, but longer term, they continue to be very good and really have that place in the portfolio for the inflation hedge, as we have seen inflation really kick up here recently.
Hey, Britt, there was an article in the Journal, I think yesterday, the day before, about how a lot of pension funds are cranking up their private equity allocations. Are you seeing clients do that? Does Callan have a view? What do you think?
They are. It's mainly because everyone's capital market projections are going down. And, you look around, you see where public equity markets are today. For the next 10 years, we're certainly not predicting that it's going to be as rosy as it is, the experience has been. So I think a lot of my clients are really looking for the octane, the return, just to eke out their discount rate going forward. I think most of them are not in as good of a position as Norwalk is in terms of funded status. And they have no choice but to take on illiquidity risk and really try to gain higher returns from those private market asset classes.
Do you get the sense there's a lot of money starting to chase existing private equity investments, and it's getting a little dicey?
Yeah, the numbers and the fundraising is certainly something I've never seen in my career. I mean, we're talking, funds that may have normally raised $2 billion in a fund are raising $5 or $7 billion and have never raised a fund so big. And, at some point, it's got to deteriorate the output and the outlook from that asset class with so much money chasing the same game and the same companies. So I think there's certainly opportunity there. And, we do, like most other firms, project a higher return in private equity, but that comes with a liquidity risk, and that comes with not being able to sell if you need to sell. And, I think there's a lot of question marks about what the next 10 years will bring.
Yeah, okay.
Hey, Britt, do we have a current watch list?
So we do. We have not presented it publicly because typically since we went virtual, we try to keep it out of the public view. But LSV was on it. I think they can remain on it. As you can see, their 1-year number and fiscal year to date number has been very good, but longer term, they still trail their benchmark. Columbus Circle was on it, given Fox's retirement and the turnover that we've seen and the asset losses that we've seen. I think while their performance has been good, we continue to monitor them very closely to understand the dynamics going on there. And I think that's it. I think the only other manager I would consider is Artisan. We've seen their track record deteriorate over the last year or two.
When was the last time they were in?
They were in 2021.
They were, huh?
They were, but there's certainly, I think this spring, I think currently, if we're gonna have BlackRock in February, I think the plan is to have the actuary in March. So maybe April, we bring them back in and see how the board feels. I think from a Callan research standpoint, we have conviction in the team and the process. That being said, it's hard to put up with a track record like they have right here.
Britt,
Yes.
okay, perhaps Artisan should be on the watch list. And we're gonna need funds where, you know, our strategy is that every 3 months, we're gonna be looking at funds. And maybe we could get Artisan in March instead of April, so we could conclude whether when we draw down money, we could be maybe possibly considering Artisan as a drawdown candidate.
Sure, I think that's reasonable. Chitsime, you okay to communicate with the actuary to have them in April instead of March?
Yes, that's fine.
Sure.
As long as that's not a problem for them, if they, because I know that they come up because they meet with the state. Well, although they're not gonna be traveling probably, but if that's not a problem, I think, does anybody have any objections to that idea of having Artisan come in March so we could review them and possibly draw down funds from them?
Yeah, it makes sense to tie, it makes sense to tie it
Really
together with the cash raising, that's fine. Again, as long as the actuary is okay getting pushed.
When we look at our allocation, international, we under or over with the non-US? With our target?
Under,
So slightly under. I think one of the dynamics when Artisan and Silchester were paired together, you know, it's really Artisan's supposed to be the growth manager, Silchester's more the value manager, and 50-50 split. You can see that obviously Silchester's done very well and Artisan struggled. So there is a little bit of a dynamic there. And so you're slightly underweight, but you know, I think a lot of that is given the run up in US equity markets that we've seen, which is really driving that kind of disparity there.
Okay.
The other
Okay.
thing is that the developed markets have way underperformed US markets over the last number of years.
Correct.
That might start to change.
Yeah,
Yeah, we were having a conversation with another client about emerging markets, and that was exactly the topic is, you know, it's been quite a few years since emerging markets have been rewarded.
Well, our Artisan is on emerging markets.
No, I was just similar conversation, but on EM instead of developed.
any other discussions on the performance? Any other comments you'd like to make, Britt?
Nothing
If
for
not,
me.
you want to go recap 21 and tell us what you're going to do in 2022?
Happy to. Well, and Tom and I put this together, and if the board has anything to add or any priorities we want to update this for, you know, please chime in. We just like to review what we've accomplished and really try to set a goal for the year coming up. So here we just have a recap. You can see performance. We did an asset allocation study for the pension plan, reviewed and updated the IPS. We now have the every 3 month cash raise policy that we'll use going forward. We had a number of managers in to do portfolio reviews, which was great. And then you can see for the DC plans, early in the year, we did the IPS and we've done the quarterly performance reviews. I should have included TCW under DC plans because they did present and they do cover both both sets of plans there. In terms of 2022 for the pension and OPEB, it has been about 3 or 4 years since we've done an OPEB asset allocation study. Just want to revisit the asset allocation, confirm that the board's comfortable and that it makes sense with today's current environment. Want to revisit the OPEB IPS just because it's been a few years there as well. One thing we want to do for all of the plans is a fee review. So we'll do that for the pension, OPEB, and DC plans, just to make sure manager fees are in line or below peers. We'll have the actuary in April, and we'll have Artisan in March. And then the DC plans, just because it's been towards the end of the year, we should review the IPS again, just to make sure everyone on the board is comfortable. I mentioned the fee review. And one thing we do want to do is have Empower back in. They last presented in December of 2020. So I want to get the record keeper back in to provide an update.
Britt, should we have maybe an annual kind of brief topic, maybe a 25-minute thing to get a briefing on liability issues in the industry?
Can you elaborate a little bit, Jim?
Well, yeah, where are pension boards and DC managers, where are lawsuits? What's triggering lawsuits? What are there any trends developing in settlements? That sort of thing.
You're thinking DC plans specifically?
Yeah, and maybe it's not worth a topic. I don't know. I'm just asking if there's enough noise out there that it's worth having a discussion once in a while.
Sure. So what might be helpful is each quarter we put out a summary of typically the litigation DC trends that we're seeing.
Yep.
We can include that every DC meeting, and if we want to make it an agenda topic, we can, and if we want to make it, just a read-only informational topic, that works too. But we'll start putting that together, and I can send it to you for the fourth quarter once we produce it, just to give you an idea. But usually it's around the lawsuits, what, if there are any trends, what are they in the current environment? Are people structuring their plans differently, et cetera? So
yeah, I mean, if it's all about fees, we certainly cover that. I'm not worried about that. It's just, are there other things out there that are starting to pop up in courts?
There are, but not on government plans, I would say. A lot of company stock issues with corporate plans and offering that in DC plans, but the litigation environment within government plans has been non-existent to my, as far as I'm aware. So
well, that's fine. We don't need to have it as a topic then. I just wanted to see if it was something worth discussing. Sounds like it's not.
Well, I'll send you what we produce, and at least for your edification, you can take a look. Perfect.
Does anybody feel that we should add anything to the 2022 work plan? Does anybody have any suggestions? Anything they'd like to see? Rich wants to know why we don't have more bonds. I want to know why we have, I want to know why we have any bonds. Anybody?
Looks good, Frank.
Somewhere in here, usually we do a capital market review. Britt, is that on here?
Yeah, sure. We can do that at the next meeting if you'd like.
Yeah, I'd like to see where people's heads are on that, just.
Yeah, we actually are hosting a webinar next week. If you have any interest, I can forward the invite to the board, strictly to review our capital market projections for 2022.
Yeah, I would. Yeah, if you would. Thank you.
Sure. I'll send that around tomorrow.
Good, thanks.
Is it a Zoom meeting or is it just a listen?
No, it's just a Zoom meeting, and it should be maybe 35, 40 minutes, and really just covers the changes we've made to our 10-year projections, and the reasons we're changing them, and our outlook, really.
That'd be good. When is that, Britt?
Bear with me. Let me double check. I think it's actually, you know what? It might be tomorrow. Days are flying by.
Is it in the evening?
There'll
There.
probably be a recording, won't there?
Yes, absolutely.
Yeah,
I
okay.
think- Okay, it's on the 19th at 12:30. So next Wednesday at 12:30 in the afternoon.
Okay.
And there will certainly be a recording. So I'll forward the invite and I'll forward the recording once it's available as well.
Oh, that'd be good. I hear crickets, Frank.
Okay, no, I was just checking something. with-
He's
I
checking
wanted
his
to
bond
ask-
portfolio.
Yeah, no, because there was something from McCrory about, and I didn't know whether Chitsame, whether there was a distribution. I mean, it's really virtually down to zero. And I was just trying to read that. But do you have anything, is the cash position fine? There's no capital calls or anything like that, Chitsame?
No, there hasn't been any capital calls for a while. Our cash position is fine. We're about 12.8 million right now. So that should get us through at least April. After those cash that we raised in December.
And so for the March meeting, maybe you could just make a recommendation of how much cash you want, because it could vary according to different things.
Of course.
Anything else anybody would like to discuss? If not, is there a motion for adjournment? And if not, we can just hang out.
Nobody wants to leave.
Move to adjourn.
Move
I'll
to
second that.
adjourn. Second.
All in favor?
Aye.
Aye. Okay, thank you very much.
Thanks,
Yeah,
everyone.
good evening.
Hey, Al.
Bye.
Good night,
Be safe.
everybody. Thank
Thank you.
you.
Good night.
Thank you.